say good morning to Bill Gross as well. Bill, what a report.
Yeah, a shocker, I think, to all of us, especially in the private sector. I mean, the market has been assuming that the private sector is coming back into the economy and that the ultimate economic growth will be self-sustaining, that is, including the private sector. But obviously in this report we see none of that. We see the private sector at 41,000 jobs, as you mentioned, and revisions in March, which basically flattens the entire private sector for the last month or two.
Any number of ways to go here, but one is the complete reaffirmation of the new normal. I mean, it was a new normal report. This struggle to get to sustained job growth. How distant are we from sustained job growth?
Well, we're going to have sustained job growth, but remember, it requires 150 to 200,000 jobs in order to reduce that unemployment rate, which is a key focus for the administration. Job growth is going to be anemic. It's going to be between 0 and 100,000 jobs probably for as long as we can see, because a significant amount of the recent economic growth, including jobs obviously with the census here, is artificial. The Congressional Budget Office has estimated that as many as 3 million jobs have been created due to government stimulus, and that means that if it were up to the private sector alone, the unemployment rate would be close to 11%.
Bill, I like the way you use the word artificial. We see that within the hinging and unhinging day-to-day of sovereign debt. Today's flavor is Hungary. Tomorrow, who knows which nation will it be? How does Pimco deal with the cacophony of news, the movement of data, the artificial sense of the market?
Well, obviously it's moving from country to country, and Hungary in the headlines this morning, and
right.
Sort of an outlier in terms of expectations. But the thrust of it is the tremendous amount of debt and where it lies. Obviously there's a lot of debt in Hungary, a lot of debt in Greece and the southern peripherals, but for the most part, the entire continent is full of too much debt.
And folks, those of you in radio worldwide and on television as well, Bill Gross in his latest research note, quoting the Economist, Tennessee Ernie Ford, and you do that, Bill, by going to 16 tons, and you're looking at the debt chart. I'm going to put this chart up for television right now. You see that 16 tons debt chart. I mean, Bill, this is not going away, is it?
Well, it goes away in a number of ways. One, you can grow out of it, but obviously Euroland and even the United States are experiencing difficulties in terms of the private sector being ultimately able to share the burden of 16 tons. Secondly, you can restructure and default, which is something that Hungary is suggesting as a significant probability this morning. And third, you can devalue your way out of it, but Euroland finds that a problem, especially with the individual countries.
Let's be bold, Bill Gross, and say we're not going to default in the United States. Let's suggest we have to restructure, whether it's the structural real economy. What would you like to see Washington to do to make for a more efficient, more productive American economy?
Washington needs to direct jobs and production in areas where the world demand exists. That, to a certain extent, yes, applies to green technology, to the medical arena, where healthcare is obviously going to be a problem for the next decades, and other areas. But at the moment, the U.S. is directing fiscal stimulus and budget deficits in the area of simply maintaining consumption, unemployment benefits, et cetera, which I think are necessary but aren't necessarily productive for an economy going forward. So it almost has to be like a Chinese model in which the government itself is directing resources specifically in targeted areas.